Did you know that only 8% of the 90,000 startups in India have ever received institutional funding? 9,000 of these 90,000 are SaaS companies, and that's what we are going to talk about today. In 2019, Indian SaaS startups attracted over $1 billion of investment, which is 20 times more than 10 years ago. But have you ever wondered why some SaaS companies are successful to raise capital while most others don't? If you are raising capital for your SaaS business, you must know and focus on the metrics that investors value the most. In this video, I will walk you through the top 3 metrics that will put you ahead in the conversation and also help you share your story in a way investors like to listen. Stay with me until the end of this video where I share an interesting insight on the investor side. This can help you significantly improve your chances of raising capital. Hi, my name is K. Chand. I've run a successful B2B company in the past. I have also been a VC partner for the last couple of years and have evaluated nearly 100 B2B and SaaS companies for investment. Let me share with you all here that all investors act differently. On one hand, there are investors who focus more on the financial metrics. So they go after data points that have been proven and offer a calculated risk assessment. Things like sales pattern, cost of customer acquisition, lifetime value of customers, churn rate, burn rate, etc. On the other hand, there are investors who invest in rapid expansion or hyper growth, relying less on data but more on projections that are based on market opportunity. These investors are willing to take more risk and aiming for higher returns on their investment. In either case, sooner or later, the metrics which I will share with you today will begin to matter. Get ready to know the top 3 metrics that investors see in your startup. First is the financial metrics. These include the monthly or annual recurring revenue, MRR or ARR. Typically, a 6 to 8 quarters data is considered reliable and VCs want to see a net positive growth every quarter. So the graph should look like this. And that is usually a very good sign, indicating there is a lot of demand for your product and there is positive momentum of growth. The other thing VCs evaluate in the financial metrics are the customer acquisition cost or CAC, which is simply the sales and marketing costs associated to acquire customers, and customer lifetime value, which is CLV, which indicates the total revenue earned between the time customers start using your service to the time they churn out. A healthy benchmark is to have the cost of acquisition not greater than 30% of the lifetime value. SaaS offers great gross margin opportunity, and investors like seeing it upwards of 60%. Then is churn, which I also say has the potential to kill a SaaS business. Let me give you an example here. If a SaaS company has a monthly churn rate of 20%, that means in 5 months they are going to completely lose all the customers they have today. And that means they have to spend a lot more money to fill up that gap and add more customers to show positive sales trajectory. Investors are also watching the burn rate or the expense rate, as they like investing in cash efficient businesses and want to be sure that either these businesses will survive till the next round of investment or will break even and sustain on their own. The second key metrics is the market opportunity. Investors want to understand if the market is here and the time is now, how big can your company become? Let me give you some context here. In the 500 plus investor pitches that I have seen, not just for SaaS but also for consumer tech, believe me, in each and every pitch, the founders claim the market size is so many $billion and is growing at 10, 15 or 20% CAGR, and the market in 5 years will be so many more $1 billion. That is a lie. They only pulled out secondary research data from IDC, Gartner and other research agencies to present a large number. It tells the investors that these founders did not do the market segmentation. Stay out of this trap. What investors want to see is a realistic market opportunity that you can go after. The third metrics is product. Investors like to understand if the code that has been built is robust, uses modern day framework, has high levels of data security, and not just built by using free codes available on the internet. Besides, if founders have claimed any intellectual property, then that will be reviewed too. So here we are. These are the top 3 metrics that investors see when evaluating investments in SaaS companies. Financial metrics, market opportunity, and product. And as I promised, here is an insight of 110-1 model with VCs. From about 100 pitches they receive, VCs show interest and deeply evaluate only about 10 of them and finally invest in one company. Raising capital is not easy. It never was. But if you focus on these metrics, There hasn't been any better time before to raise money. Remember, investors want to invest in entrepreneurs who are in touch with the reality and not in those who stretch the truth on baseline of passion, optimism, and projections. Feel free to hit me up in the comments section. If you had any interesting fundraising experiences, please do share your story. That's all for now. Much love.